So my name is Sharnesh D, guest lecturer of Government First Grade College, Kurgod. So today I would like to explain profit prior to incorporation, problem with solution. So I have to take, let us start problem, see the problem. Papu Limited was incorporated on 1/8/2016 to take over the running business from 1/4/2016. The following was the statement of profit and loss for the year ended 31/3/2017. Particular note amount total. First one continuing operations. First one revenue from operations. Note number one amount 2,40,000. Second one other expenses. So 2,40,000. So I have to take other income. So revenue from operations to note number one 2,40,000. Next second one other income nil. So 2,40,000 total column. So total here total revenue 2,40,000 rupees. Total revenue rupees 2,40,000. Next third one expenses under expenses cost of sales note number 2 direct outer column 1,44,000. Next B employees benefit cost note number 3 salaries 12,000 director fees 1,000 total 13,000 employee benefit cost. Next C finance cost note number 4 debenture interest amount column 2000 interest to vendors on 1/1/2017 4,500 total 6,500. Next depreciation and amortization. So note number 5 direct outer column 11,400. Next other expenses rent and tax note number other expenses note number 6 under other expenses rent and tax 7,200 amount column traveler commission 2,400 office expenses 10,800 discount 3,600 audit fees 1,500 bad debts 1,200 carriage outwards also 1,200 formation expenses 2,400 and advertising rupees 4,800. Total these amount added you have to take outer column 35,100. B total expenses 2,10,000 profit A minus B, so profit is 30,000. Now adjustment the total sales for the year amounted to rupees 2,40,000. However, it is ascertained that sales for April were 1.5 time of the average sales of the year, which the sales for July, November and March were only half of the average and those for June 2 times of the average sales. Next, out of the total bad debts, rupees 700 relate to bad debts create prior to incorporation period. Prepare the statement of profit and loss account to show the profit prior to incorporation and after incorporation. Solution, you have to take solution first. First, calculation of time ratio, prior incorporation period from 1/4/2016 to, so company purchased, running business purchased 1/8/2016. Some beginning date is 1/4/2016 to 1/8/2000. Purchasing date is 1/8/2016. So you have to take difference between this 4 month. So April, May, June, July. So these are 4 months we have to take prior incorporation period. After incorporation period 1/8/2016 to 31/3/2000, this is the closing date. Purchasing date to closing date. So closing date. So 1/8/2016 to 31/3/2017. So you have to take 8 months. 8 months. So here first running business you have to purchase. So here one. So beginning date running business from 1/4/2016, but purchasing date 1/8/2016. Closing date is 31/3/2017. Next, calculation of actual ratio. Second one, actual period ratio. So first prior incorporation period 4 months, 1/4/2016 to 1/8/2016. There are 4 months. You have to take 4 months here. Next, after incorporation period 1/8/2016 to, so I have to take 1/8/2016 to vendors, interest to vendors 1/1/2017. So I have to take 1/1/2017, 1/1/2017. So August, September, October, November, December. So this is the 5 months. So this is 5 months. You have to take 5 months. So from the date for incorporation to actual period of actual date of payment. So there are 4:5 ratio. So 4:5 ratio actual period ratio. Next, now sales ratio, calculation of sales ratio per month and sales ratio. So average monthly sales, annual sales divided by number of months is equal to 2. So total sales is 2,40,000. So average monthly sales you have to find out first. So in this total sales of the year amounted to rupees. So ಇಲ್ಲಿ 2,40,000. However, it is the ascertain that sales April were 1 point time of average sales. If you first you have to calculate 2,40,000 divided by 12 months. So you have to take 12 per 2 to 20,000 per month. You have to take 20,000 per month. 20,000 per month. Prior to incorporation period from 1/4/2016 to same you have to take 1/8/2016. There are 4 months. 4 months. So in April, so 20,000 equals to 1. So 20,000 equals to 1. So I have to take first one. The total sales for the year amounted to rupees 2,40,000. Next, April 1.5. You have to take April 1.5 times of average sales. There are given adjustment. So I have to take 1.5 into 20,000. So is equal to 30,000. May average monthly sales direct you have to take. There is no given of the adjustment in this month. You have to take. So direct 20,000. April 20,000 average sales. This is the one. Next, June 2 times. You have to take 2 times. They are given. So here 2 times. So June 2 times. You have to take 2 times. So 2 times in 2 time into 20,000 is equal to 40,000. Next, July off. You have to give. They are give July, November and March. You have to take July, November and March. So off July time, off times of 0.5. So 20,000 into 0.5 is equal to 10,000. So July 10,000. Total prior incorporation period sales. So this is the 1 lakh rupees. Next, after incorporation period, one from 1/8/2016 to 31/3/2017. So purchasing date to closing date. August average monthly sales direct you have to take. There is no adjustment in this. So I have to take direct 20,000 average monthly sales. September average monthly sales rupees you have to take 20,000. October also average monthly sales you have to take 20,000. So November given adjustment. So in this adjustment you have to take November and March were 1.1/1 means it average monthly sales is off ಅಂತ ಹೇಳ್ತಾ ಇದ್ದಾರೆ. So it means off means, so you have to take off. So November is off average monthly sales. You have to take 20,000 into 20,000 into 0.5 divided by 100. So I have to take 0.5 divided by 1. So I have to take 10,000. December average monthly sales 10,000. Next, average January also same 20,000. So December also 20,000, January also 20,000, February also 20,000. You have to take March also adjustment given 0.5. So you have to take 0.5 into 20,000. You have to take 10,000. Total 1,40,000 plus 1 lakh 2,40,000 total sales. So this is the prior incorporation period and after incorporation period sales. So you have to take prior incorporation period sales is 1 lakh and after incorporation period sales is 1,40,000. So sales ratio that sales ratio is 5:7. Now let us start with the statement of profit and loss account. So here for the year ending 31/3/2017, particular basis of proportion and prior to incorporation and after to incorporation period. So I have to write it same as it is question. So continue operations. So first one, revenue from operations. So here sales already given. 5 is sales actual given already, actually calculated 1 lakh into 1 lakh 40,000. All sales ratio you have to take 1 lakh 40,000. So 1 lakh rupees and 1 lakh 40,000 you have to put it here. So now other income is nil, other income nil. Total revenue 1 lakh 40,000. Next, expenses. Third one, expenses. Cost of sales. So sales ratio, you have to distributed sales ratio 5 is to 7. So total 1 lakh 44,000. So I have to take 1 lakh 44,000. So to take 1 lakh 44,000, you have to distributed 5 sales ratio. So 1 lakh 44,000 sales ratio. So 60,000 pre incorporation and after incorporation 84,000. B, employees benefit cost, salaries, time ratio 1 is to 2 ratio. So you have to take 1 is to 2 ratio, distributed 12,000 is their total amount. You have to take 4,000 and 8,000 rupees after incorporation period. Director fees, you have to take 1,000. Director after incorporation, director prior incorporation period nil, and after incorporation period direct 1,000. Next, C, finance cost, debenture interest after incorporation. Directly you have to take after incorporation period. So you have to take direct after incorporation, prior incorporation period nil, and after incorporation period 2,000. Interest to vendors, you have to take calculation of actual ratio. In the actual ratio means in this ratio 4 is to 5 ratio, you have to take 4 is to 5 ratio. So actual interest to vendors, actual period ratio 4 is to 5 ratio. Total 4,500 is there, to 2,000 and 2,500. Prior incorporation 2,000 and after incorporation 2,500. Next, depreciation time ratio 1 is to 2 ratio. So 3,800 prior incorporation, after incorporation 7,600. Next, other expenses, rent and taxes, time ratio. So after time ratio, you have to distribute time ratio 1 is to 2 ratio. So total, so 6,000. So 2,400, 4,800. Traveler commission sales ratio 5 is to 7. So total 2,400. So 1,000, 1,400. Office expenses time ratio 1 is to 2 ratio. So here 10,000 plus 10,800. First prior incorporation 3,600 and 7,200. Next, discount. So at office expenses time ratio 3,600 and time ratio. So 10,800 is there, time ratio 3,600, 7,200. Discount sales ratio 5 is to 7. So 3,600 is there. So 1,500 prior incorporation period and after incorporation period 2,100. Audit fees time ratio, you have to take 1 is to 2 ratio. So 1,500 is there. So 1,500 in the above profit and loss account. So 500 and 1,000 after incorporation period. Bad debts actual given. So actual given prior incorporation period total 1,200 is there. Prior incorporation period adjustment. So here prior incorporation period adjustment, you have to take 7,000 bad debts in prior incorporation. After incorporation period 500. Total 1,200 is there. Next, formation expense after incorporation period. So nil, prior incorporation period nil, and after incorporation period total 2,400. Advertising sales ratio 5,000, 5 is to 7 ratio. So prior incorporation period 7 2,000 total 4,800 is there. Prior incorporation period 2,000 and after incorporation period 2,800. Total expenses B, total expenses prior incorporation column 82,000, after incorporation period 1,28,000. Total profit A minus B, 1 lakh minus 1 lakh minus 18,000, remaining balance is 18,000. 1 lakh minus 82,000, remaining balance is 18,000, the profit prior to incorporation. Next, after incorporation 1 lakh 40,000 minus 1 lakh 28,000, so remaining balance is 12,000. So profit to A minus B. So profit column is profit after incorporation, so 12,000. So this is the problem of average sales method.